Hello, everybody. This is Eugene Yashin with Student Financial Management. I would like today to update everybody on the state of the stock market, and this is our March 8th presentation. Please take a look at our disclosures for compliance purposes. And today I will be speaking about the overall state of the U.S. equities. We'll, as usual, take a look at size and style cycles. I will briefly discuss our recently added financial laboratories. We will talk about our multi-factor macro sector forecast, and also we'll take a look at which factors are working at the moment in our multi-factor models. We'll take a closer look at the our actively managed individual equity portfolios, and we'll briefly discuss the changes we recently made to those. So, as you probably all know, the global economy is on the rise. There are early signs that some of the developed economies start feeling the constrained capacity out there. The U.S. Is actually not in this cohort. The U.S. has only 75% of its production and manufacturing capacity used at the moment, so there's breathing room for the local economy. Markets are wary of trade wars, and with the last, tariff implications, we can see how this, trade wars could actually damage the economic situation at home and all over the world. However, on balance, we do believe the environment remains very supportive for U.S. equities. The recently, with the fourth quarter numbers closing, the earnings and sales came out at with beats at highest rates in years. Inflation is still normal, and there are no signs of overheating. And with the recent correction in February, the equity valuations seem pretty reasonable to us. As you can see from our chart, value growth dynamics of the marketplace, whenever we find the line of the graph above the red line, it means that the value companies prevail. Whenever the line goes below red line, growth companies outperform. Obviously, we've had a pretty strong growth cycle recently, but as you can see, the line is shifting and turning. So we do expect at some point the change in the regime and the value companies to come back. From the size standpoint, the last couple years we saw, at least especially not couple years, the last year we saw large cap outperforming small cap pretty strongly. This year, small cap is actually catching up, and on the 3-year moving average, you can see that small caps start actually getting back into the game. So at this juncture, it's very hard to judge where we end up this year, but we definitely should be more neutral with regards to size posturing. I do have pretty exciting news. We recently started a couple financial research labs at pretty, high-profile business schools. We started two research projects at Wharton Business School and several research projects at High School of Economics. In February, we visited Wharton, and we actually talked to students We briefed them on the two projects they're about to undertake, and those projects will cover macro cycles and multi-factor modeling for individual equities. The students are very excited. Students come from very diverse backgrounds, and it's going to be interesting. We're going to see how they actually learn and apply their knowledge to real-world problems with statistical analysis and machine learning. Back to our macro view. I usually show this chart on yield curve and credit spreads. Again, at this point, nothing to worry about. We do see credit spreads are still pretty subdued, and yield curve, although flat, does show some signs of perking up as inflation expectations start rising. Interestingly enough, when we run our multi-factor macroeconomic model, right now we don't see any sector in the neutral posturing. It's more either black or white, so to speak. So we do have positive outlooks on financial, technology, healthcare, real estate, telecom, and utilities. And you can see that a lot of these sectors are actually of value nature. So our expectations of actually the style cycle turning to value are supported by our macro view. And on the negative side, we have consumer discretionary and energy, which have been there for a while, but we see industrials and materials actually as new addition to the negative cohort. That's just pretty much kind of this the reiteration of the same message. As you can see from this progression, this is the same heat map of progression of our forecasting with regards to each individual economic sector. You can see that utilities have been in green for a long time, and consumer staples are gaining momentum. Financials are still kind of green, but you can see some complications possible in the future for financials. Healthcare actually is turning green, which is pretty encouraging for the sector, which has been clouded with controversy for a while. The sectors we have been bullish for a long time, like industrials and materials, are turning reddish. So we actually we follow our discipline, and we made the changes in the portfolios in accordance to our macro view, and we'll talk about it momentarily. So our view doesn't change drastically. We still favor GARP stocks, growth at reasonable price stocks, but we start seeing that some of the more of a value factors of value stocks could be looked upon favorably right now. A lot of sectors have gone down in valuation, in relative valuation, and if 2 years ago, a year and a half ago, you looked at utilities, consumer staples that being really overvalued. Right now, they're not. Their valuations have come down. They've underperformed quite a bit over the last year and a half, and so the play field is kind of even right now. We still see very strong corporate earnings, and that encourages us. And I think from that standpoint, the corporation still pretty bullish, and the management, actually we see that in the management behavior as well, with more capital expenditures on the table and bright outlook from managers of U.S. companies as well. Global economic expansion does continue, but as I discussed before, there are some signs, early signs of potential, capacity constraints forming up in the developed world. So we just need to be monitoring that carefully. So let's briefly talk about the factors. As you know, we run multi-factor modeling, and we rank individual equities and ETFs with those models. We did make some changes to our long-term score. We've expanded it. We called it S-Score Plus. So S-Score Plus covers as well all the aspects of an individual company, from the valuation, growth, quality, safety, and technical/momentum standpoint. You can see the progression over the last 5 years of those factor groups, and you can see our score, which combines all of them, how it behaved. When you see red in this heat map, it means that for this particular quarter, our score underperformed. So the top quintile of the companies ranked by the score underperformed the average of the universe. And you can see that in comparison to the previous version, our score actually gives us some improvements and actually smooths out the transition from one investment regime to another. Let's briefly discuss our, what worked and what didn't work in our individual equity portfolios. So because we just started the year, it's March 8th, so we are 2 months, 8 days in the new year. We decided to take a longer period, 14 months, and look at our portfolios from the attribution analysis standpoint, what worked and what didn't work. I'm really glad to see that our overall allocation, worked pretty well in the portfolio, and our selection process still contributes with a positive contribution. With regards to specific sectors, we had underweight energy, which worked in our favor. We outperformed in information technology with, overweight and with the overall selection of companies within the sector. We outperformed in healthcare with pretty strong selection of firms. We outperformed in industrials, again with a great selection of companies in the sector, and real estate. We underperformed slightly in financials, and most likely with the biggest contribution was from selection, but allocation was slightly negative as well. So we do want to repair that a little bit. We underweighted consumers, both consumers, and we slightly underperformed in those sectors as well, and materials as well. But overall, our selection and allocation was on the positive side over the last 14 months. So what changes did we make? We slightly increased large cap. We kept the mid cap posturing, but we do watch small cap development very closely. As soon as we see sustained moving forward from small caps, we will definitely allocate more of the portfolio to small caps as well. Style, as I said before, we started tilting a little bit more towards value, but overall we maintain our GARP posturing. And at the moment we keep overweight technology and financials, and we're closing gap in telecom in response to consumer staples, telecom, and utilities progressing to outperform. What we sold, Voya, Quest Diagnostic, Northrop Grumman, and New Market. Voya, we try to um, that cell was more of a fundamental cell. We wanted to emphasize financials, but with different flavors. So we replaced really Voya with Morgan Stanley and Legg Mason, which gives us a little more emphasis of the flavor of financials we wanted to see in the portfolio. Um, uh, Quest Diagnostic we replaced with United Therapeutics. Uh, we would like to emphasize more of a biotech/pharmaceuticals in the portfolio. And Northrop, we didn't really replace anything with. We just wanted to really take the profit as we go and really reduce our exposure to industrials. And New Market as well, we're pretty much reducing exposure to materials as well. So you can see that our moves on individual stocks actually reflect our macro view as well. So this is how our portfolio looks like, what our portfolio looks like right now. As you can see, information technology and financials are the biggest two sectors in the portfolio. But we do have a very healthy representation of other sectors as well. From the size and style standpoint, we're still pretty well represented in large cap with large growth and large value, pretty much representing 2/3 of the portfolio, more than 3/4 actually of the portfolio. Mid cap, and we have a small sliver of small cap, which will grow bigger as we see small caps catching up. Our strategic dividend equity portfolio, due to its mandate of producing yield and giving exposure to more of a brand names, large cap, well-known companies, that constrains our ability to maneuver in the portfolios a little bit, but nevertheless, we try to be creative here as well. So we maintain our large cap posturing in the portfolio. We keep value-oriented portfolio, which will hopefully help as we turn to value in this investment regime. And right now we're trying to, again, reflect our macro view on the portfolio. So we overweight financials and we close gaps on utilities. Now, with that, we sold Starwood, Lockheed, and Dow DuPont. Again, Starwood was a REIT, but we replaced the REIT with a different financial, Apollo Management. Lockheed Martin, reduction in industrials. Dow DuPont, reduction in materials. And we try to emphasize here Kimberly, consumer staples, Apollo Management Financial, GlaxoSmith, a large pharmaceutical/biotech, and the DuPont Energy, that's a utility company. We elected to increase our exposure to utilities as well. And that pretty much brings us to the posturing of the strategic dividend portfolio. You can see that financials and healthcare represent the biggest sectors. But again, information technology for the portfolio of this kind is very well represented. Industrials and energy follow. So overall, this is a very well balanced portfolio, which produces a pretty healthy dividend yield. And as you can see, it has a very large cap representation with the sprinkles, not the sprinkles, but still pretty healthy medium cap representation and small cap. So in this particular instance, we have close to 18% in mid and small cap representation. That will conclude our presentation. I do thank you, and if you have any questions with regards to this presentation, please do not hesitate to write me at eyashin@signetfm.com. Thank you and have a wonderful day.